So, today we're going to be talking about time horizons. So, basically, what you're predicting to gain an edge in the market and over what period of time, and how difficult the different types of predictions are. Because if you don't be really specific on, okay, what am I trying to predict over what time period, and do I understand the difficulties and the challenges of trying to predict this thing over that time period, you're going to run into a lot of issues. So, I'll give you an example of a few different types. If you haven't seen my last video, by the way, where I kind of give a basic overview to this, I'd recommend watching that. I'll leave the link somewhere around here. But essentially, one example would be, okay, I am trying to predict that one specific company is going to make more in their earnings, which comes out every 3 months usually, is going to make more than what everybody else thinks. And because it comes out every 3 months, you've kind of solved both problems at the same time. You're like, okay, my time horizon is basically up to 3, maybe 6 months if you include 2 cycles. And what I'm trying to predict is that a company will have better earnings than we thought. So that's something specific, and the time horizon is specific as well. In terms of the difficulty of something like that, it really depends. And you're going to see that a common theme throughout this video is the difficulty always depends. But one thing as a principle that I will say is that the more people are watching the method that you are using, the harder the edge becomes. What does that mean? You may have heard of people in the past saying that if your trading edge is so good, why would you share it with other people? There is some merit to that in a lot of cases, and the reason is because the more an informational edge gets shared, the more people know about the information. The more people know about the information, there's less of a gap because it's being priced in. You must remember that the markets are a machine to price in value, and they're determining that value based on information. Now, the markets are really efficient, meaning that if you have information, the markets are always trying to price that information in, and the more people are watching it, the faster that information gets distilled into the price. So a lot of people think they're going to predict the future using information that everyone is looking at and looking at that information the same way as everyone else. For example, that could be on a macro perspective going, oh, GDP is up for this country. Okay, that's great. I'm going to buy the currency. It's very laggy. That's an example of something that's really lagged, and it's so slow to actually move and change that metric. So that's going to be too slow because everyone is watching it and everyone is looking at it in the exact same way. But then you've got another layer of, okay, well, what about the people who were able to forecast GDP before it actually came out? You're also competing with those people. And the more people watch the market, the more of those people there are. Call it smart money, call it whatever the fuck you want. That's the bottom line. Now, on the other side, if we're looking for the informational edge, which is really what the whole idea here is, and again, I discussed that in the last video, you're kind of baking this into your strategy in some way because you're looking at, okay, what is something that other people aren't looking at, or then they're looking at it but they're not understanding the true gravity or the true power that it actually has the potential to move in terms of the stock or the market or whatever. In that sense, if you do your job correctly, the difficulty is much easier than you might think. Not just that, but we also have a lot of advantages over your investment bankers, institutions, these sorts of things. People who notoriously, we kind of have an ingrained belief that we have a disadvantage. But we have advantages. We can move and act on information way quicker. We can take risks that they can't because most of the time they are paid not to lose money. That's not always true, but for the most part. And also, they're only looking at things through a very narrow lens. They normally all went to the same sort of schools, they had the same sort of education. And so the way that they are looking at the world is through a very, very, very specific lens. And when everybody's looking at the same thing through the same lens, then your chance to find something like an outlier in terms of value, because that's what we're really doing as investors, finding value that's unrealized yet, it gets smaller because you can't beat everybody else by doing the exact same thing. It just doesn't make any sense. Anyway, so let's look at a different style. So let's look at somebody who's predicting the markets on 6 to 18 months as a time horizon. Now, this is typically going to mean that they are looking, not necessarily, but looking macroeconomically. It could be an individual company, but bigger things. So think the entire stock market rather than an individual stock, or an entire currency instead of individual aspects of the currency, like interest rates or specific parts of the bond market, whatever. And so that is going to be different because what you're looking at there is you can't look at that kind of micro data about consumer trends that may be really helpful for the picking an individual stock. But what you could look at for the macro is you know that everybody else is looking at the information that you're looking at. So at face value, it's like, okay, well, how could I possibly get an edge? And the truth is you need to look for what I call model risk. This is not a term that I made up, and I don't even know why I just said that that's what I call it. I'm pretty sure loads of people call it that, but whatever. My point is that when you look at how everybody else is doing something, if you really understand what they're doing and how they're doing it, you can find weaknesses in what they're doing. And if you understand what the weaknesses of what the masses have, and this is key because just a weakness on its own is not important, because sometimes you can have a weakness to a system that is a weakness for a reason. You have a weakness paired with something where you can say, okay, this is a weakness of their system, but I know that this other thing is really important and has the potential to move markets. If you pair those two things together, what you actually end up getting is a powerful potential for an edge. Now, the example I gave in my last video of somebody who does this, Gary Stevenson, you can have an average, right? So it could be inflation, and it can look like inflation is steady. But if you look at what inflation is made up of, submetrics or distributional data, you can see trends that someone that's just looking at the average is going to ignore. Now, why would people ignore that data if it actually moved markets, you might think? Well, because of many, many reasons. But I would say the most dominant and clear reason for why most people would ignore it would be that it is harder to incorporate into quantitative models. What do I mean by that? If you're building something that's very mathematical, working with averages makes everything much easier to build a model off of. The economy, for example, is very, very complicated as it is. And when you're looking at the relationship between, let's just say you had 10 economic indicators that were all averages, things like GDP, CPI, which measures inflation, the ISM services, all these sorts of things. You have a big range of these. And you're building a model that looks at the relationship between, okay, when this happens to this, how does that affect this? And then does that affect this? And you're doing that with 10 data points. Mathematically, that's already really, really, really difficult, right? And so when someone comes along and says, okay, well, now let's actually expand this even more and add, 10 submetrics to each of those metrics. So it's basically 10 times 10. That's 100 metrics that you're looking at the relationship between them and weighting them and figuring out, what to give the more credit and less credit and all this sort of stuff. That's really, and I mean really, really difficult. And so most people don't do it, right? And also, again, come back to the education thing. Gary Stevenson talks about this a lot as well. Is most people are trained to look at the averages. It makes sense to have basically an average view of the everyday person and use that to come up with a solution. Makes sense. But it misses the granular details, and those granular details are where you can actually find an edge. And so again, bringing it back to difficulty. How difficult is it over this time period? Well, it depends on the nuance of how you use it. For example, on a more kind of week-to-week scale, it could be, let's just say that we have an inflation metric, so CPI coming out next week or whatever, and we are like, okay, we know that the moment that comes out, algorithms, which are going to be faster than you, are going to see the same information in the same way, and they're all going to react probably in a similar way at that time. Small margin for an edge. Edge potential, but small. So the next step would be, okay, well, can I predict what the inflation is going to be before it comes out? This is going to be quite difficult to do, but it's possible. Again, if you really understand what you're looking at, but it's difficult. And really, in an ideal world, I'd say if you're going down that road, it's going to require an element of specialization. You need to know how CPI is being calculated because it does change over time, and you're going to need to understand how it's being calculated and what things influence that metric and whether you can track that in the real world and come up with a statistically more accurate way of coming up with that over time. That's going to be quite difficult because realistically you're looking there at needing probably 2 years of practice of where you forecasted it, then the real result came out, and then you're comparing how good your predictions are versus not just what actually came out, but also what other people guessed it was as well. Because for every economic metric that comes out, there's also a forecast. So for example, we have GDP, it will show you the previous GDP metric, but then it will also show you what all the economists are forecasting. And so if the economists are already forecasting it pretty accurately, then it's going to be really difficult for you if you just have a tiny little edge. It's going to be a little bit tough. It might give you a little bit of a heads up, sometimes, but for the most part, it's going to be tough. But if you have a way where you can, after 2 years, you're like, oh, I know that I can actually predict this pretty accurately, even when most can't, a decent percentage of the time, that could be something where you can build an edge out of that. But again, very difficult, and you need a lot of time to actually go and figure it out. And I would imagine that for the most part, most people aren't super interested in that. To be honest, I don't blame you. And so then that's one example. If we zoom out a little bit and we're going, okay, well, what's the general trajectory of what we think is going to happen with, for example, like an economy as a whole? So, for example, we could say, okay, well, I think that interest rates are going to go up and everyone else thinks that they are going to go down. In that scenario, it's a little bit, I'm not going to say easier, but if you know what you're looking for, it's a little bit, I would say it's still easier than picking like an individual metric of, like inflation or something like that and trying to predict it. That's a personal opinion, and definitely I have room to be wrong there. That's without a doubt. But for me, I would say it's a little bit easier. The reason I'd say it's a little bit easier is because you, number one, have more time to actually make the decision. Number two, there's a bigger range of data that you can look at, of publicly available data. Whereas if you were trying to predict like an individual metric like inflation, you're going to have to probably go and source a lot of alternative data that may not be kind of available to you that easily, etc. So that would be another example of the market. But then you've got things on like a 5 to 10 year time horizon, all this sort of stuff, which is more about kind of long-term cycles. I quite like Ray Dalio's stuff on, short and long-term cycles. That would be more looking at the themes of how like economies tend to play out over the long run. It's a little bit more difficult to bet on directly. Like you're not going to find, a traditional trading edge there. That's more portfolio management. But it's important to know, and it's interesting to know, because then it gives you an idea of, okay, well, how could this influence everything else? And so this kind of brings me into the last point of this video, which is understanding the relationship between X and Y and Z and moving this all together. Because if you understand the macro picture as well as the micro, it can give you insights that reduce your risk. I'll give you an example. Of recent, the S&P 500 has been rallying. We've reached all-time highs. We are continuing to rally at the time of making this video, and things have been really, really great, right? Bull market, everyone's happy. Most people are making money, easy peasy. But the real best traders and investors are the ones who are able to have some kind of a balance of knowing how to avoid the downside risk, or at least reduce your risk when things are going down. And that is something that is why it's important to understand the macro. Now, if you're interested in learning about the macro, I will leave a link for that video somewhere above this. I haven't made it at the time of recording this, but by the time you're watching this, I probably have, where I break down the actual macroeconomic environment and how and what are the most important drivers of it. But let's just say that you know and you predict that, okay, I believe that when X, Y, and Z happens, I think interest rates are going to go down. Then you're like, okay, that means that I think that as a macro, the stock market in general is going to have a bull run. That means there's a lot of money in the stock market. It's probably going to be risk on, meaning people are happy to take risks. From there, I'm like, okay, well, if everyone's doing this, what are everyday people saying? Do they have money? Who's spending the money? What sort of things are those types of people interested in? And then I can kind of narrow down a sector and maybe a subsector of companies that maybe of interest, and maybe where I can begin to look for a more specific informational edge. That's if I wanted to go down the specific company route. Similar thing with currencies, it would be the same sort of thing. But that would be an example of having essentially the macro and the micro as a pair. Now, the last thing that I will say is about finding your unfair advantage. This is going to be absolutely critical, because if you look at the best investors of all time, most people don't actually look at them as investors, because they're normally not investing in what most people think of. And most people think of investing, they think, I'm going to put my money in the stock market, I'm going to put it in this, I'm going to put it in that. But the people that typically get the best returns are typically people who are investing in private companies. Now, am I saying that, I'm not basically saying that everyone has to get into private equity, which is what I'm talking about. But herein lies the clue of finding your unfair advantage. If you have somebody who has started their own, several of their own businesses over, let's say, 10 years in a very specific market, they've dominated it. Someone that comes to mind at the moment that's always floating around as you take your kind of Iman Gadzis of the world, who kind of started with a marketing agency and then kind of got in the information space and sells courses and all that sort of stuff. He invests into private companies and gets really good deals, right? And has control over what he invests in. Like if I invest in a company on the stock market, I have no control over the asset, right? But he has control, and so he has the best of both worlds. So he has industry knowledge, he has an audience, which is massive leverage and allows him to grow the company and have an unfair advantage. And then he uses that to increase both cash flow and the value of the company, which means his return on investment must be ridiculous. I would guess it's something like 10x, or something like that. That's something that you're going to struggle to get consistently in the stock market because number one, you don't control the asset. So it's purely about information and how well you can disseminate and stay up to date and manage risk. And also you don't have, did I just say control? So the point I was trying to make is that when you're investing, as I'm guessing most of you are investing, so S&P, individual companies, FX, whatever the fuck it is, you have no control over the underlying asset. So it's purely about the skill of your analysis and your knowledge. And also your sphere of competence. So what do you know best? The more you know about something, the more close you are to the ground and running, the more of an advantage you have. Imran Gadzhi has an advantage with selling information and things around that. That's why he buys companies like WAP or investing companies like WAP and Flozy. These are things that are geared towards a specific type of business owner in a model that he understands with an audience he already has. Example of a massive advantage. Now, for somebody who may not have those things, you could still have an advantage in terms of knowledge because you must understand that with this type of investing that we are doing, or that I'm doing, it's all about knowledge. It's all about knowledge because we can't control the outcomes. And so it's all about how well we can understand and predict things that are going to happen and relying on everybody else. So there's a lot of stress on the actual knowledge, but the leverage is massive because obviously, just the amount of money you make is pretty much determined by your percentage return and how much money you had to begin with. And so, yeah, so, if you understood, for example, I don't know, submarines really, really well, like you did it for 20 years, you are going to understand developments in that industry way better than some finance analyst on Wall Street that is like dissecting everything. It's going to be a completely different ballgame. And so within there, you have the potential to outperform those people because you know more than them. And so this is really the crux of everything. You need to understand what your unfair advantage is. Now, you may not have one right now. You may think you don't have one, but you probably do. Maybe it's something that you really like buying, and you buy it all the time, or something that you have got experience in, or something that you've done, or something that your family does, or something or people you're connected to that you can ask about who are experts, but you're not. These sorts of things are places where you can find your unfair advantage. Doesn't mean you need to be some sort of like madman trying to understand an unfair advantage and everything. A lot of it can be observational, which I think I'll talk about in the next video about how to actually make decisions and find these things in real life with some examples. But yeah, it's just about understanding where your unfair advantages do lie. So look, I hope that has been helpful. In the next video, I think, as I said, we're going to be talking about some examples of predicting and examples of doing this and finding your unfair advantage and finding things that other people ignore and how that's affected stock prices in the past. So hope you have enjoyed and I'll see you there.